everyone, this is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. For those of you that are new joining us, and we have quite a few newbies tonight, welcome. I wanted to give you a quick rundown of the format on TradeFinder. We do this each and every Tuesday night. First of all, we have to start off with this wonderful disclosure / disclaimer that the powers that be want us to show you. If you are new, take a screenshot of it, read it in detail in your leisure if you would. A couple of things that I wanted to point out that are very important is that we are not registered to give individual investment advice in the United States. And because we have a lot of international viewers, international subscribers, any pricing that we're talking about is assumed to be in US dollars unless denoted otherwise. So those are the two biggies, but again, please read it at your leisure in detail. All right, with that said, let's go ahead and move into taking a look at the chart with where we are now in the markets. If you watch the, hopefully you've watched the SPY update, the market update that we did for the S&P 500 today. A lot of you have watched it already. Hopefully those of you that are viewing tonight have watched it as well, where I mentioned that yesterday's move didn't mean anything. Today's is kind of a little bit more meaningful. I'll cover that in a minute. If you haven't had a chance to watch that recording, I'll make a few brief comments in conjunction with what we talked about in that recording. I don't want to reiterate the whole thing because I want you to watch it, but some brief comments of how markets tend to react around presidential elections, not playing politics, just general movements of the market in conjunction with elections. But the main thing to take a look at is the fact that we did close below this important level here at 340. And it's not a Elliott wave or Fibonacci level. This is just a plain old support resistance level, a la moving average, etc. It acted as resistance back in August. We broke below it, traded through it in September, fell below it at the end of September, came back, traded through it for 3 days, broke above it, and now here we are testing it again. Yesterday really didn't mean much other than a test of that level because we closed right on it after trading below it, but today we did. So we can't really count today as a break to the downside for two reasons. One, it's an inside day, meaning that the high of the day was lower than the high of yesterday. The low of the day was higher than the low of yesterday. In addition to that, it's only one day. Remember, when we have a significant break of support, resistance, major moving average, et cetera, you have to have 2 days, a follow through or confirmation day. And so one day is concerning, but tomorrow would be more meaningful if we close again to the downside. Then we have to start taking a look at the 61.8% fib level, which I'll go through and show you now. So far, this big zigzag pattern, which started in the wave 5, beautiful 61.8% fib corrective level, 100% extension to the upside here, is still intact. Nothing has affected that, and we're not even really close to affecting that yet. We would actually have to break below that B wave corrective level and come down and hit the 70% level, according to Elliott, to negate this zigzag pattern to the upside. So that's not been affected at all, even though it feels like, wow, the market is super ugly right now. Doesn't it? Spooky, as we said in the previous recording, talked about the market's getting spooky, and it's been moving to the downside ever since. Maybe we shouldn't have made that recording because it's been moving to the downside pretty much ever since we did that. However, we wanted to focus on this set of lower highs. That is certainly not positive for the market, but look what I just drew. A descending triangle pattern has formed now with that 340 level acting as support, and you can look at it and say, yeah, but no, the support should be up here. I view things when you have a major support level, even if the lows of the bars in the triangle aren't necessarily touching that, you have to take into account that major support resistance level. So I still stand by drawing the set of lows there right at 340 with a really nice set of lower highs. And we tried to sneak out of that today to the downside. So to me, tomorrow means a lot as far as what happens in the markets. Right now, the futures are down another 18 points. We sold off right at the close. In fact, the market was, I wish you could look at an intraday, hopefully you do. I would encourage you to do that, to look at an intraday chart, because we chopped right around 340 all day long. So I'm talking about this 340 level being important. We broke below it just before the market opened. So I'm talking about the futures, obviously. And then throughout the day, we hit it at 10 o'clock. We hit it again at noon. We hit it again at 1:45, and we tested it for the last time at 3:45. All of those bumping against the 340 level until we sold off right into the close. So support resistance levels matter. 340 level matters. The market proved that today. It's not just my commentary. Take a look at the market, and you'll see that same action bouncing against that level. So it had broken below it. It kept testing it. We couldn't really get meaningfully above it. That certainly be viewed as a negative. But in addition to, and it just so much Elliott stuff going on right now. It's fascinating. I love this stuff when it's like this. And we have this complex C wave that has now formed a 50% corrective B wave, and instead of that 38% level. And because we've come down to a 50% corrective B wave in that C wave zigzag, our 100% target is not now exactly aligned with the 381 level on the big zigzag extension. Still showing a move to new highs, potentially qualified, but not congruent with the 381 level, which is interesting. So if we break to the downside out of this triangle, then perhaps this last zigzag becomes negated, but not yet. We have to break below 61.8. So the same rules will hold in play here, that if we break below this and come down to the 70% level, then we have to start paying attention to, is this 61.8% level going to hold? Because this zigzag here, the complex C wave zigzag, and this is really unusual because we have both a zigzag pattern and the descending triangle. So let's redraw that and go through this, because this is really good educational stuff here. Is basically in that B wave with the 50% corrective level, it's a complex B because it contains the triangle. So we had a mono A and we have a complex B. That's actually pretty good as far as how zigzags normally work. We're about to do our educational series. We just released the flats, which is, again, not my favorite strategy, but so important to understand. I mean, it's going to really play into, hopefully you've watched that. And if not, you can find it on our website to understand, are we in the midst of a flat or are we forming a zigzag? And if you like to trade zigzags as I do, well, you need to know the characteristics of a flat, because if it's showing characteristics of a flat, then it's not a zigzag. And you don't want to put on a trade for a zigzag if the Elliott wave pattern is telling you you're in a flat. So it's important. My point is that whether or not you're like me and you prefer to trade directionally, then the sideways stuff, if you like to trade sideways, then just get good at flats because it's an ideal strategy for it. But if you like to trade directionally, you still need to understand the rules for creating a flat, because you don't want to put on a directional trade if it's telling you you're going to go sideways. So hopefully that makes sense. So it's just fascinating pattern right now. Elliott wave all over the charts right now with what's going on. So again, the next day or two is going to tell us a lot. By the time we get together again next week, wow, we're going to have a lot to talk about, aren't we? Because we have election day. We have this pattern will likely have given us a better signal as far as what's going to happen from here. So we just need to wait a few more days. We've been a little bit quiet on our alerts over the last week as far as new alerts. It's a little bit elevated VIX getting up to 30. Not the most, I mean, 25 is great, but when you get up towards 30, you're even a little more cautious on the triangle patterns because you're going to be paying a little bit more for the options. 25 has been great for us because we've had a lot of really good ones. One I'm going to share with you here in a few minutes. But you know, there are times when the best thing to do is let the pattern come to you. I think the most important word, if there's one word that I can tell you that's really important to be successful in trading, and I'm sure you're going to think knowledge and education, those are going to be the two things that come to your mind. I like to add in experience in there, but that is, none of those three are the words that I'm going to talk about if you get to the point where you're really confident in your technical trading system, the word that I'm talking about is patience. Let the pattern come to you, because a lot of times you're going to jump the gun and you're going to make a mistake. You're going to exit a trade that you should have stayed in. You're going to stay in a trade that maybe you should have exited. But patience, let the pattern come to you, and trust the technicals. If you don't have that kind of trust in your system, then find a new one. This is why we're doing these TradeFinder events, is to try to share with you the power of Elliott Wave. This is why our subscribers just enjoyed a new record that we had. If you haven't watched the YouTube videos lately, we're doing a giveaway where we're giving away 10 free quarterly subscriptions, because set a new record of 17 closed winning trades in a row. I'd done 13 twice in the past, but 17 is, we blew the record away. And then the loser that ended it was like a 2% loser, which ended the streak. You know, we want to share this with you. We want you to enjoy the kind of success that our subscribers do, or maybe just subscribe and come along with them. Go to our website and become a subscriber. If you do that, if you subscribe, because the contest goes to the 31st, but if you become a subscriber and you happen to win the contest, then we just credit you for those 3 months that you would win. So come along with us. The VIX is elevated. The market's moving. We're at 33 on the VIX. And as soon as this pattern becomes clear, we're going to be jumping all over it. So this little lull is a great time for you to get your toes in the water and become a subscriber and come along with us. So those are the things that I wanted to share with you. Now, last thing I want to do before we move into showing you our case study that our subscribers just enjoyed, the profit they just enjoyed, which was a good timing on the exit, is the presidential election. And I don't play politics. I have my own political views. I keep them to myself. I'm committed to my views, as I'm sure you are. So I don't want to get into a pissing contest on whose views are right. What I always do with these webinars and talking to you and technical analysis is just simply talk about how politics factor into the markets. Not which political party is right, not which one's my favorite, none of that stuff, just how they affect the markets. And historically, now the reason I'm sharing with you is because this really irritated me today. Quick story here. I like to tell whatever. I like to tell stories. I watch the financial networks most of the time on mute. I just have them on because if something happens that I feel like I need to know about, so that I can share that with you, etc. So I'm woken. I've got this spaceship here with all the screens. I've got a TV screen. So while I'm watching the market and everything else, the financial news is on in the background. I said something today which reminded me of a time when I threw something off my desk and broke a TV screen. So for Christmas that year, my kids gave me a foam brick as a joke. So if I got angry at what was being said, I wouldn't at least break the TV. But the same thing came out today where they're saying that a blue sweep is good for the markets. And I just want to share with you, historically, the data has shown that the market does well when there's a Republican administration. The market does well when there's a Democrat administration. The market does best when one party doesn't control the presidency, the Senate, and the House. So it doesn't control the presidency and the Congress. The market likes it when there's, status quo or infighting, if you will, because it feels like nothing extreme is going to happen because the market doesn't like uncertainty. And when you have one party that controls everything, and I don't care what your political beliefs are and which one you think is best, I'm just giving you what the historical standards are, understanding again that nothing is 100%, but historically, that's how the markets have done best, when one party doesn't control everything. So there was a commentary that came out today that, oh, a blue sweep is going to be good for the markets. That's when I wanted to throw something at the TV again, because historically that doesn't hold true. Now, that could be the viewpoint that if the Democrats control everything, they win the presidency, they sweep or they convert the Senate and they maintain the House, that there's going to be a much bigger stimulus package. Maybe that's true. And maybe the market does do a short-term bounce on that. But historically, again, the markets don't like it when one party controls everything. I look at that as a negative, even if there's a short-term bounce. If there's a short-term bounce on that, I think it's a wonderful opportunity to sell into. So I just wanted to share that with you, because don't buy into that. Don't get sucked into that if one party is controlling everything, then it's all, great and wonderful to move forward in the markets. That's just not what the markets have shown historically. If Vice President Biden were to win, but the Republicans control the Senate, then the market could still do well. And again, I don't want to fight with you on political beliefs, etc. That's just how historically the markets work, and that's how we're going to be setting things up as far as our analysis of Elliott wave, etc., and what they show. So anyway, I just wanted to throw that commentary out there so that you don't get caught in and sucked into propaganda. Now, why would people be saying that? Well, investment managers get paid for assets under management. They don't want people to be running for the hills if there is a blue sweep. Does that make sense? Because if they get paid for assets under management, so however many people have their money in their accounts, they get paid a percentage of that. They get a 12B1 fee off of the amount of money that they have under management. So if they view that, oh, that's bad for the markets, and they all start pulling their money out, they don't get paid as much. They don't want you to do that. So the propaganda is going to come out that obviously that there's, some thought process that may happen. So they want to get ahead of that and lead you to believe that, oh, don't pull your money out of your accounts if that occurs, because then they get paid less. That's the motivation. That's just how it works. So I wanted to share that with you. Okay, so let's go ahead and look at this case study on our website, which was on TCBI. This is a long strangle in our volatility strategy, as you can see, and returned 84% in 29 days. And our entry was on September 23rd. So TCBI is a Texas banking company. And we've been talking about how interest rates have been rising up, and had a feeling that we were going to get maybe some better results from the financials than a lot of people thought. Financials have had to figure out how to make money with basically zero interest rates. And so if rates start to tick back up, that's a really big boom for them and the opportunity to make more money. So we had this really classic looking Elliott wave descending triangle here right on top of the support. See on that support level? See, isn't that very similar to what I was just showing you in the market? You can see that the lows weren't all exactly on that support level. Same triangle that I just showed you in the S&P. And so we bounced up against that level in April, end of April, May again, broke above it. I mean, how close is this to what we just looked at on the SPY chart? And then this descending triangle on top of that support level. We had a ADX that was very low, right at levels that in the past had yielded directional moves out of this stock. So everything was there to set up one of our, I still like to use the word proprietary, even though they tell me not to, because I just haven't seen anybody else do strangles exactly the way we do them. So somebody finds somebody that's been doing it longer than I have, please tell me and I'll stop using that word. But we exited on October 23rd. So here was the exit, and here was the breakout move. You can see big move to the upside, and we could have closed it the day before. And a lot of people might have said, why didn't we close the day before with that big breakout move? Well, we hadn't quite closed that gap. And you know how I feel about gaps, so I even need to go through that. We bounced up again the next day, filled the gap. Well, now we're getting to the point where with an ADX above 40, outside the positive directional indicator, we gapped up, we filled the gap. That's a pretty meaningful point to go ahead and take your gains. And so again, 83% in 29 days. So this was kind of around the time frame. This gives you an idea of what our subscribers enjoy with volatility strategy is around a month in each of these strangles. That's about the time frame that occurs. 83% is a little above the norm. It's usually a 30 to 70% profit range. So this will be considered above average or slightly above average is a good one. I wanted to show you the dot plot because once again, realized a really nice gain, but showed a loss for a bit. And that's how these strangles work is you're buying a call, you're buying a put, you suffer the effects of time decay, theta decay, And for a while, we had one big blip right away, but not enough of a profit to consider closing it out, not enough of a breakout of the pattern, which is important. So then we sat here in a loss for about a week or so, broke up, came back, and then we got the big breakout move that we were looking for and close the gap. So it was time to go ahead and take the gain. So I like to show you this mark-to-market thing. Again, as far as transparency, we've had a lot of nice comments from our subscribers, unsolicited testimonials. You know, normally, what's the expression in the whole sales world is that someone is 7 times more apt to write a comment when they're upset than they are when they're happy. That's a lot, 7 times more. And so we've had an awful lot of really nice comments during this win streak that we've had, and we appreciate people that sit down, take the time to write a note that they're happy with their service and how things are going. But one of the common themes of the recent comments has been the transparency. We show you everything every single day. We don't keep anything from you. And that's the way we want to do things. Is we want to show you. We want to share our successes with you. We want to show you what we learned from the losses and help you learn. And hopefully there aren't too many of them. There haven't been lately. And we want to try to keep it that way. But that's how trading works. There's profits, there's losses. And if you have more profits than losses and you manage your risk appropriately, you make money in the long run. That's how you become successful. So that was the case study that I wanted to share with you this week. And isn't it interesting that with what's been going on in the market, just to remind you here of this move to the downside that we've had, the market has been doing nothing but going down since that high on the 12th of October. And yet this was an upward breakout that occurred while the market has been moving to the downside. And again, the reason this broke to the upside, in my opinion, is the fact that interest rates have been ticking up. And this stock still has more to run. But I thought I would bring up and show you a current chart of TCBI, because it's always good to go back and see, you know, you have to be happy with your profits. I've mentioned this numerous times. Don't second guess yourself. But it's always good to take a look at how things pan out. You're always curious, right? Well, could I have made more if I had waited, whatever. And the trade is actually much below where we closed it out. We did close just a little bit higher the very next day, but then today back to the downside. So all in all, it worked out extremely well as far as where we are. But see how we've had this, and this would be worrisome if you're still bullish, because there's a pivot point right there. Are we going to head back down? Did we just close the gap and then we're going to head back down? We'll just have to wait and see how that pans out. But so far, so good as far as the close there. All right, so let's take a look at, we had a number of different case studies. Last week, we struggled to find one. If I remember to really commit to one, we wanted to look at MGA, and we needed a follow-through day. That was the thing, to see if it followed through. So let's go back to last week. Well, that looks good. So somebody remind me of what was it that was holding us back? Because I wrote that it needs a follow through. Well, that looks like a pretty good DMI. Was it because of this break? Must have been because of this break here. That's what it was. The break above resistance. So we needed a follow through from there. And so if we take a look at this, that would have been certainly considered a good follow through day with a new high. And then over the past couple of days, we've come back to test that with the market. We did not send this out as an alert to our subscribers, even with that next follow-through day, mainly due to the fact of considering what's going on in the market in general. And I think that's an important lesson as well. Follow your system, but also pay attention to what's going on in the market as a whole, which I think goes to Elliott's rule of follow the higher degree. We've done a lot of education in our series that we're doing, talking about not just the higher degree, but breaking things down into a lower degree, which I think is really an important and exciting aspect of Elliott Wave. Is that if you ever wanted to branch away from equities and move into currencies or futures, etc., the fact that you can use all these same patterns that are broken down into smaller time frames is very important. So the lower degree is something to look at as well, but Elliott just harped on this a lot: follow the higher degree. And in my opinion, you can make a leap of, when you're looking at individual charts that are part of the market as a whole, that would qualify as a higher degree, just like looking at a daily to weekly chart or a weekly to monthly chart being a higher degree. Always pay attention on what's going on in the market as a whole. So we've been holding back on doing anything along those lines, even though what we said last week was look for a follow-through day, which we did get, but we didn't go ahead and send that one out. So let's take a look at the week before. Let's go back 2 weeks and take a look at PayPal, which we did send out 2 weeks ago as an alert to our subscribers. And you can see we had this big move to the upside, and then we're harboring right here around this 200 level. And even in an ugly day, as we had today in the markets with the sell-off into the close, PayPal still managed to finish up 1.6% on the day. It's still looking pretty good. If we break below this level of 200, it's kind of like that same 340 level on the market in general. If the market falls apart, then even some of these that we have that are outperforming the market in general may succumb to the market. That's what usually happens. And some of that moves into forced selling. Like, even though a stock may not be directly involved in whatever is causing the market to move to the downside, but investment firms have to have a certain amount of cash on hand for people that want their money back or want to take their money out. So they have to have a certain amount of cash on hand. So they're forced to sell positions that they may not want to in order to raise cash. Now, we're not there in the market yet by any way, shape, or form. Just giving you an analogy of why the majority of stocks fall when the market falls significantly. So that's really the reason. Some companies that may actually even be doing well in a current down market environment, their stock price could go down just because investment firms have to sell to raise cash, and they work the percentages appropriately. So 200 needs to hold here, and so far today it did. So nothing really in this that's making it look too concerning. The negative directional indicator did tick down today. The ADX is curling down a little bit. But as long as there's separation between these two directional indicators, we could turn back to the upside in short order. But again, this is probably going to move along with what the market does. So let's also take a look at BIDU, which is also one that we sent out to our subscribers as an alert a couple of weeks ago. And look how that one is outperforming the market. Just, it doesn't care what's going on. We've got here the market with this set of higher lows for 2 weeks, and then you have BIDU with an amazing run of lower highs. And you know how I feel about this, right? I mean, if you've watched any of the videos, look at this. So we had support right here where the wave 2 is, support level, nice support, and then we've been moving up in this nice channeling formation here with a set of lower highs, and it's at a 45-degree angle, which is the main thing that I wanted to share with you. So absolutely, positively love this pattern. If the market doesn't fall apart, you can't really ask for much more than that. That's about as good as it sets up. So 1.46% gain on this one. So think about that. These two that we have that showed up on our search, when the market was down today, PayPal finished up 1.6%, BIDU finished up 1.4%. So roughly both of these were up 1.5% on a down day. Again, they'll probably get sucked into the siphon if the market does tank and breaks below that 340 level meaningfully. But if the market does hold here, these are really poised to take off to the upside and will outperform again if the market holds and moves to the upside. So we watch these, we stay in them because they haven't given us a reason to get out. There's no real reason to exit these. So there's, you know, pretty good proof of 2 weeks there that these stocks have outperformed the market. And that's what we like to believe in our system. We believe in our system that it will outperform the market. So if you can outperform the market and then manage your risk in a prudent manner, you're going to make money. You're going to be successful. That's how you hang around 25 years in this business. That's simply how it works. It's not really a lot more technical than that. All right, so that's the market, our case study that our subscribers had, our case study considerations for the past couple of weeks. Now let's go ahead and take a look and see what we have for this coming week. And if we take a look, there's 3 impulse ones. And that really surprises me. People always make comments about, why are you surprised? Because I make that comment a lot, right? Because when I look at these and I look and I see things that surprise me, they're like, why are you surprised? Well, we've had nothing but lower highs for the better of 2 weeks, 2+ weeks. We've had nothing but lower highs. And yet we've got 3 that are moving to the upside. So let's see what we have. Houlihan, Insperity, and Thermo Fisher. This is TMO we've seen a lot since it showed up a lot over the years. And I have no idea what this is. Houlihan, LOK. Let's take a look at the options before. I'm just curious. It's always fascinating to me when I see stocks show up that Houlihan, Loki. And we have December options, nothing in January or February. Then we go all the way out to March, 143 days away. Super wide spreads, a little bit open interest, but just for an example, on the 35 delta, there's a 0 bid. 0 bid, $4.80 ask. And you might look at that and say, well, just split the middle. It doesn't work that way. If there's 0 bid, then you're not going to get filled on that one. But it was up $2.05 today, as you can see on the move with the breakout move. But let's just take a look at it from a technical standpoint, but it's not tradable, really. So this is what I was talking about from the DMI as far as PayPal. See that? See how that looks? It could easily turn exactly the way this one just did on Houlihan. So that's the potential there. That's kind of a good illustration of what I was talking about as far as what could happen with PayPal if it hangs in there. And so taking a look at this, we just moved to, well, we closed right at the highs. I thought we had broken the new highs. We're in the wave 3. Would imagine that that's a disqualified zigzag here. Yeah, just barely 71%. So it actually went through, but we wouldn't have traded that because it was disqualified. So even the disqualified zigzag actually hit its target. That's pretty fascinating, isn't it? I mean, what kind of system is that when you have one that's disqualified and still works? That's a pretty good system, isn't it? I mean, that should give you confidence. I mean, you could look at that and say, well, I would have missed that. That's not the right way to look at it. It's not a way to look at it like, oh, well, that would have been a nice move and I missed it because I followed the system. The way you want to look at that is that one wasn't good enough to qualify and it still worked. You see the difference there? That's the way you want to look at the system that we're sharing with you is that, wow, even one that wasn't qualified still did exactly what it was supposed to do. And let's just take a look at that again, because I want to show you what just happened with the test. So we had that 100% extension. We broke above it. We came back and tested it, and it's off to the races. And there's a great chance that this is going to go. Let's see where the 161.8% level is. I bet it's pretty darn close to where that wave 5 target. Look at that, right smack in the middle of the wave 5 target. So when I look at this, I don't look at this as one I missed. I mean, we wouldn't have had it anyway because it wasn't tradable. But again, from a technical standpoint, it just has to add to your confidence in what you're doing, that this one very likely is going to go up and hit that wave 5 target right in the middle of the tap box where the 161.8% level is. That's fascinating to me. I think that's really cool. NSP. Uh, 127%. So we're already in extended wave 5. A lot going on here in this chart. So let's take some of this stuff off. Pretty good looking DMI here. Negative directional indicator. So sellers going down, buyers asserting themselves. That's what you want to see as far as a divergence. So basically we've gone a bit sideways here for a week or two, but the ADX has been moving up. So that's divergence, right? Stocks going sideways. Strength of the move, building underlying is moving up. Positive directional indicator moving up. All those things that's the kind of divergence that you want if you're putting on an upside trade. And then we can go through and look at this big zigzag pattern here. With our target right there. So with a 38% B wave correction, you'd be looking for, look at this. So, I mean, I love showing you stuff like this, and even the Elliott wave options people, we talk about this stuff. We get together and we chat and we strategize all the time, and we still are amazed, even after all the amount of time that we've spent, all the years that we've traded this. It's still fascinating when you see it work time after time after time. Look at this consolidation right at the 38.2% level. That consolidation didn't happen here in the middle of no man's land. It happened right here at the 38.2% extension level. And now we're starting to use that, pardon me, kind of that launchpad effect that I talk about, with a potential move up to the eventual C wave extension at 61.8. And that would be your target. That's where you would expect it to go with a 38% B wave correction. So let's take a look at this. I still think that caution is important with where we are in the market. There's not a whole lot of open interest in this, but the spreads aren't wide at all, considering. I mean, we got 40 to 50 contracts going out to January on the different strikes, but the spreads aren't that wide. Not a whole lot more open interest in December. That's pretty fascinating, really, that the spreads are kind of contained here. They're 30 to 40 cents wide, but relative speaking to the amount of open interest, that's really not that wide. So, by the way, that TCBI trade is at 475, which shows you how much more money that we made on the close. So I still have it on my screen. But taking a look at this, not a lot of open interest. The 25 delta, which is where we look to trade, only has 52 contracts going out to January. It's not that bad. It's not a lot of open interest, but the spreads aren't that wide. So even if you're trading with the market makers, they can't really take too much of advantage of you in that scenario. So that's a consideration, honestly. It doesn't look bad. And then the last one, Thermo Fisher. Look at that run. Looks like maybe we're getting a touch extended on the DMI. Let's take a look. We're not at 40 yet. We are in the upper end of the range. Similar situation here where the negative directional indicator is pointed down, the positive is up, kind of at the exact same point with the ADX. The ADX has been moving up, but this is just powered ahead. It's just ignored the market itself with these set of higher lows. This is like, oh, we don't care what the market's doing. We're just going to continue to move to the upside. It looks fantastic. Moving higher up, there's a problem, right? We're at our wave 5 target. Yikes. So we're right at the wave 5 target with the DMI. So when we see this, right, it's only a 52% extension. So what's the thought process when you see that? Well, when you've already reached one price target, so it's basically done what it was supposed to do, right? It's hit the Elliott wave target. This is where we were supposed to go. But you know that a wave 5, a C wave of a zigzag can have extended waves, right? I mean, that's all part of Elliott wave. Well, how do you forecast whether or not you're going to get an extended wave to the upside? Well, the best way to take a look at that, in my opinion, is the DMI. The DMI is what we rely on to say, hey, what are the chances that we're going to move up to an extended wave 5? So that wave 5 could move up to 100% easily within Elliott wave rules. But when you've got the ADX that's at 35 already, you can go back and look, and it's always a good thing to do, I think, to look historically. You can see that the ADX made it up to almost 45 in the past. So that gives you a point of reference where it could do that again. I don't know. I think this one, to me, looks a bit better. The Insperity chart, that it's just, boy, it's really tough to go long something that just hit a price target unless the DMI was back in this area. So if we saw this, where the ADX was moving up, breaking above 20 or 25, we're well within or between the two directional indicators, and we look like we're moving significantly to the upside, well, that would be an okay, we're going to the extended level. That's the DMI is telling us this trend is really strong. It's likely to continue. You are likely to have an extended, in this case, wave 5. But that's not where we are right now. Where we are is up here. And maybe this one does go higher. It would be interesting just to keep it on a. I actually have two watch lists. I have a watch list that stocks that are getting ready to trigger, and we want to keep an eye on those and see if they become worthy of sending out alerts to our subscribers. And then we have I have a curiosity watch list where it's just, I'm just curious to see what happens. It's not like we would put a trade on it. You know, there's just certain factors that you want to see play out. It all goes into, you know, adding just experience of, okay, well, if I see that again, then you can remember the previous experience. And that's all technical analysis is, right? It's what happened in the past. If you see something similar now, you can come up with a reasonable expectation that what it's doing now is going to be similar to what it did in the past. That, in a nutshell, is technical analysis, in my opinion, and Elliott wave is the best at it. It's the best at analyzing human behavior and what's likely to happen, because we don't change our behavior. We still have fear and greed as our two primary emotions. I think we always will until we all become AI robots. Then maybe it changes. I don't know what trading would look like in that world, but I don't think we're going to be around to experience that anyway. So whatever. But I think that NSP is one that we're going to make a note of. So I'm going to write this down for our case study consideration. Going to put a little asterisk by it. And the asterisk for me means what happens in the market tomorrow. Obviously, if we sell off hard in the market tomorrow, you're not going to put on a bullish trade, even though we've had two with PayPal and BIDU that moved up today in a down market. But if the market gets significantly bad, they'll move down with it. If the market hangs in there, we just teeter around here, we're kind of uncertain going into the election, and we're just playing around at these levels, then those two stocks will likely continue to outperform. So the asterisk to me means unless we have some sort of a significant move down tomorrow, the futures are still about the same as where they were when we started. Nothing too exciting to talk about there. So that's those. I did want to take a look at this. I think this is bearing watching right now. Remember how we can do the consolidating stocks, which is 117. So we're not going to go through and look at all those, but we can combine that, which is really cool. So we can take the Elliott wave consolidating stock search, which is basically looking for those triangle patterns, and combine that with wave 4 buys, which are stocks that have been pulling back. They're in a wave 4 corrective move, and see how those would look as far as any potential results. And there we have 3 again. So let's just take a minute to look at those, and then we'll get to the questions. Just out of curiosity, I want to see, because I think this could be an interesting time frame for those. The only thing that I see here that's even remotely interesting is we kind of have this little bit of the launch pad effect, where we've been going sideways for 2 months, but we've been going sideways at a pretty good support level. I don't know if this has any options, if it's even worth trading, but this one would really go on. This is not a curiosity watch list. This is a potential trade watch list with where that wave 4 is at 34%. Plenty of room, huge room to the upside with a potential move, and the fact that we had this bit of a launch pad and the potential blast off from this, and you would probably have a free run right at those recent highs. So that's right up here in the 52 range. So we could explode up to that. So you get a good 10 points easily before you even run into resistance. So if the market does find some footing here, we're probably not getting a stimulus package before the election. I think that's part of the reason that we've been moving down. I think the market has realized that it's not happening in the short term. We're just too close to the election now. I just can't imagine watch it happen tomorrow. Just because I said I can't imagine it. And what have we talked about? Somebody actually re-quoted me, because the quotes that I use so often, like the 10-day moving average one, etc., is that you don't trade what you think. You trade what the charts show you. Trading what you think is going to happen is a fool's game, and that's how you get blown out. So my opinion means nothing, and I want to make sure that that's really clear. My opinion means nothing. Nobody's opinion matters. What matters is what happens, and the charts are a reflection of what is happening in the market. And your job is to listen to what the markets are telling you, not try to project what your thoughts are onto the market, because they don't care. It's not listening to you. But the market is talking to you, and so your job is to listen to the market, even if what the market's telling you makes absolutely no sense to you. And I can tell you that happens a lot. What the market's doing makes no common sense a lot of the time, but you have to put your ego and your thoughts out of it and listen to it. So I think this one's pretty fascinating. So let's go back to looking at the options. Wow, there's a lot more than I thought there was. There's no January though. We have to skip all the way to February, which is getting pretty far out in time. And when you go out that far, the spreads are a bit wide. There's an opportunity in December. There's 199 contracts on the D's 50 strike. It's not awful, but we would have to see evidence of the launch pad from here. But that one certainly goes on to, let's keep an eye on it. So hopefully I'm giving you enough information as to why PVH also trading at a support level. This one's a descending triangle though. Right here on support. This one looks, where was that DMI again? This one's probably going to trigger really soon. In fact, it might, well, it had to have, right? Because it was on the combined search. It probably triggered just today on the consolidating. This one looks good for a potential strangle. We'll see what the options look like here. Not on a directional breakout, but just a pure pure strangle. There are January options, and there's decent open interest on it. Spreads are a bit wide, though. Not too bad. Not too bad. That actually is a pretty decent looking, that's a pretty decent looking strangle there. That's the kind of stuff that you want to look at. Would like to see the VIX below 30, though. This 33 VIX. I have to do some options analysis on that one. If you are a subscriber and you're watching, if this one doesn't get sent out to you, it's because the IV is just too high. So I need to do some options work on this one before I can say, oh, that would be a good one. So I don't want to say, oh, that's a good case study consideration. The pattern is good. I like all that stuff. But with the VIX at 33, you got to really tighten the screws on the options analysis. So I'm not ready to say that yet, but I'll be looking at that tomorrow. And for those of you that are subscribers, if that one gets sent out to you, then you'll know why. You'll know that it did fall within our parameters. And if it doesn't, that's the reason why. And if it breaks out, you're probably going to go, well, why didn't you send that one out? Well, if it breaks out and the IV is too high, it can break out and we still don't make any money. So the important thing here is that we want to make sure that when they break out, we do make money. That's the whole idea of it. And without it, then we don't have that. And this is very similar. Not quite as great a support as the last one, but also a bit of a descending triangle pattern, just maybe a little bit messier than the other one, but it's also bigger. And this one, I'm anxious because we have traded this one before. This one is hard to trade because the spreads are super wide, or at least they used to be super wide. And this stock used to move like crazy. So this one would show up on the strangle search a lot because of that. There's no January options. December is way too tight. In this one, there's a lot more open interest out into February anyway. It's pretty expensive. Not as expensive as it used to be, though. So it's come down quite a bit. It's actually probably doable. So this is another one that we'll take a look at. I really do like, I think this is a tighter pattern. It's a neater pattern. This one's a little bit messier, but it's also a more volatile stock that can really go when it wants to. And there you go. I mean, all you have to do is look at history here. And you could argue that that wasn't the greatest descending triangle pattern there either, right? It was one, but it wasn't the best looking one. And look at the explosion that occurred out of that. So that's 4.5 points. This day it's 11 points. Yeah, that works out nicely when you have it when you have a trade on that. So again, another one that will be doing some options analysis on. So I'm glad we looked at those. You just kind of helped me with what I'd normally be doing later on after we finish this broadcast anyway. All right, take a few questions and then we'll wrap things up. After hours trading at FSLR. What happened after hours? Oh, earnings. Okay. It was a pretty nice move to the upside. Well, we'll see. I mean, that was a pretty big move. I mean, it's interesting because this was talked about on the financial networks as a stock that somebody came on and they were talking about bubble stock. Actually, it was Einhorn, who's well respected. He's a well respected money manager, billionaire at a young age. But he said that this was a bubble stock. He listed several of them that their price was in Bubbleville, and and then here it comes, and I don't think he expected this on the earnings report. They absolutely blew away earnings. So the estimate was 60 cents, 59.9 cents, and it came in at $1.45, and it's rocketing to the upside. So the question that was asked is, do I think that'll hold into the open? Well, at some point, it's definitely going to be to the upside moving into the open. Sometimes that gets sold hard when you get a move like that. We're also really close. The high on the after hours was 98.5. And so, you know, where we are, we're right next to that 100 level, the tractor beam level, as I call it. So they may take profits and sell hard into it right at the open, but we'll see. I don't think anybody expected those kind of numbers. That's amazing, really. Good question. Apple. Mal asks, is there a nice triangle pattern for Apple for earnings, or do you trade this pattern for earnings? And boy, when you have an earnings report, if you're far enough away that it doesn't spike the IV too much, then earnings are great for triangles. And so 10:29 after hours, so what's Thursday after market? I would have to look at that. Yep, you called it. That's a really nice pattern. I think that is a very nice Elliott wave triangle pattern here. Yeah. That's interesting the way Elliott wave draws that. I would have maybe looked at that as more of a symmetrical triangle, but from an Elliott wave standpoint, it certainly has the characteristics of a kind of a rising descending triangle. So that's interesting, the way they view it versus the way I would view it. Regardless, it doesn't really matter. It's still a triangle. So, I mean, label it however you want. The labeling doesn't really matter. It's the breakout potential that's there. Haven't been looking for this kind of thing on Apple in a while, just because of the market float. But with that kind of a pattern, yeah, the ADX just didn't quite dive down low enough to show up on the search. But that would be a good one. It's a great question, Mal. I mean, you got to look at the options and see what the IV is. That's where the catch-22 comes in, because the majority of stocks, let's be honest, the majority of stocks have an increased implied volatility moving into earnings, right? They just do, because we all know earnings reports move stocks. What you have to try to do is find out, is it more than the expected move? What kind of a move is factored into the options on the breakout move? And looking back historically, is that a realistic move? Can it outperform what's forecast in? That's when you make good money. So if it has some built-in IV, that's not necessarily a negative, but if it's like an enormous amount of built-in IV, well, then even a decent breakout, you can't make money, because we know what happens to the IV as soon as the earnings report's announced, right? The IV goes down unless you have a big downward breakout. That's the only thing that holds the IV in there. If it's not a significant move to the downside, then the IV crush occurs right after earnings. So answer to your question is it would need some work, but it's a good pattern. And earnings report, other than if it pumps in too much IV, is not necessarily a bad thing at all. It's a good thing because it moves the stock. And when we do these triangles, that's the only requirement we have. We don't care if it moves up or down. So we take the direction out. The only thing we need is for it to move. The one thing that hurts us in the triangles is if it goes sideways. That's why we look for the triangles. We look for patterns that historically do move and break out. And if you can kick in an earnings report on top of that, that's the cherry on top, right, of moving. Luis, do I see the SPY trading in a channel? I don't think so yet. I think I went through that pretty well as far as, I mean, the two zigzags. I see this descending triangle. I mean, that's really what I'm looking at there, is that descending triangle. And what's likely to happen, the futures have been dead flat. Robert S., great name. Does the gap have to close? Robert, could you specify? I mean, that's the thing, right? When you all ask questions when I'm going through charts and then I come back at the end, if you could include the symbol in your question, because I'm not 100% sure which security you're asking the question on. Gap around 330. So I assume are you talking about the market there? I'm not sure. And Steve, again, I'm not sure what I see where you're looking at our confirming indicators that we like, but I'm not sure exactly what security you're talking about. Okay, Robert says he's looking at the SPY. Does the gap at 330 have to get closed? It doesn't have to, but you know how I feel about gaps. My opinion, they do get closed. And somebody did some research, and it was 94% was what they found. And they went back because of the comments that I was making, the gaps get filled, gaps get filled. And they went back and did decades of research, and they came back with, wow, 94% of gaps do get filled. The caveat, though, is when, right? I mean, they don't have to get filled, or at least in my experience, there's no time frame. Sometimes gaps fill immediately, like look at these two. So we had gap, 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 which is why we got out of our SPY calls, because boom, boom, boom to the upside. Those gaps have all been filled. And so your question is, doesn't this one have to get filled? So I'm focusing on that word is semantics. I get it. My viewpoint is, yeah, that gap will get filled at some point in time. Does it have to? No, but I think it will. Does it get filled now or at some time in the future? That's where the question is. And that's the problem, isn't it? Is that we just don't know that. That's the hard part of it. But yeah, I understand why you're asking the question. It's a good question. Steve, I agree with you. If we find one that's not tradable, at least from an option standpoint, paper trade it and learn from it. That's an absolutely great point. Totally agree with you. Is the 10% rule on the alert price the same for sales, selling out? Oh, I assume that you mean you got the alert to sell and it dropped faster than you could get out. I would, yeah, as far as, you know, that's something that you have to consider, right? If the stock has moved, as long as you're within 10%, I would say, yeah, absolutely close it out. If you can't get the price of the alert when it went out for whatever reason, I would say if it's still within 10%, then go ahead and close it out. If it's not, then then you're kind of flipping a coin as far as whether it goes out. There are multiple reasons that we choose to get out. Sometimes we get out because it hasn't hit the price target yet, but there was an IV rush or something that we wanted to capture. And so we made the decision to go ahead and take the alert, take the profit and close it out, even though it hadn't hit the price target yet with that IV. And, you consolidate a bit and then it runs higher and you get, a price down the road. That's when it becomes a little bit trickier. But as far as your question, yeah, the 10% rule will be the same. As long as you can close it within 10% of the alert, go ahead and take it. NVIDIA, boy, I haven't looked at that one in a while. So that's a new one as far as here. Not a new one, really. We've traded that one numerous times over the years, but not so much lately. Boy, all the gamers have just been gold for this stock. With the pandemic and everything, people staying at home. Look at this move. If that's not a good example of the 45-degree angle that you hear me talking about so often, that's why I like that 45-degree angle move, because look, it hasn't corrected hard. That's the reason. But what happened when it went vertical? See, when it went vertical, what did it do? All this time, this is a great example. This is what we're going to finish up on tonight. What a good question. Thanks, Ken, for bringing this one up. This 45-degree angle, the whole time on the way up, not a significant correction the whole time. But as soon as it goes vertical, what happens? Boom, vertically right back down. Makes my point exactly on why I like the 45-degree angle, why I stay away from stuff that's gone vertical. Because when it goes straight up, quite often it comes straight back down. And when it goes straight up, you're going to get a harder correction. You just are. Don't get sucked into this stuff. Don't get sucked into the vertical stuff unless you're already long and you use that to get out. Okay, so it came back down and now we've moved back up and we've moved a bit higher. But still, you didn't have to absorb that big move to the downside. Use that vertical move to take your profits and get out. But the trading them, getting sucked in when a stock has had a nice run and then it goes vertical, and then you're like the FOMO, fear of missing out, and then you jump in at the top here, and then you absorb that downward move because it occurs right after you got in. That's what really stinks about trading. So please don't get sucked into vertical moves. Just stay away from them. I know it takes discipline because it's so hard not to when you see a stock going straight up. But just remember this chart. It's a perfect example. So your question about this one, so we went up. We've kind of taken a look at those highs. Pretty much an exact chart to where the markets are, right? With this set of lower highs, they're small bars. Nothing too upsetting here. I would have to say that if I was long, if I was still long this stock, I don't see a reason to get out because we've had this here. We've got a bit of a triangle formation there. That wouldn't be worrisome because that is a corrective triangle within a wave 4. This is kind of what I was looking to at the two scans combined to see if you can find one that's in a pattern that's likely to move up here. The DMI is not going to be conducive when you see that pattern. I don't think I could enter it right now unless, I mean, it's a $550 stock, so you're not going to find a good strangle on it. But I would keep a close eye on it. And if we get a confirmation, a confirmed breakout to the upside, so 2 days to the upside, then I think the likelihood of going up to this wave 5 target is really high. But don't jump the gun and get in that ahead of time. What a great chart to end on. Hope you found this informative. As I said before, get out and vote. It's a right that we have. It's a privilege that we have. Let's utilize it. Make your voice heard. Thanks for your attention tonight. And boy, it is going to be a fun session next week, isn't it? Woo, can't wait for that one. Have a great week. Talk to you next week.